Hello everyone. Welcome to our latest market analysis. Today, we are discussing the Tokyo Housing Market Report for January 2026. The title of our report is The Great Decoupling. The data from late 2025 shows us that the market isn't just changing, it is fracturing. We are seeing a structural break between asset inflation in the center and real demand in the suburbs. Let's dive in. First, let's look at the executive summary. We have entered an unprecedented selection phase. Three distinct phenomena are driving a wedge through the market. Number one, the different dimension. Central Tokyo has completely detached from the rest of the region. Number two, the failure of small scale. The old strategy of making houses smaller to keep them cheap is no longer working in the city center. Number three, the mutation of the used market. Buyers are priced out of new homes and are flooding into the secondary market, changing how we value pre-owned properties. Let's look at the data for the 23 wards. The 100 million yen wall is no longer a ceiling, it is now the baseline. In December, the average price for a standard new detached house reached 106.42 million yen. This is the second consecutive month over 100 million. With a 7.5% year-on-year growth, we must face a hard truth. A house in central Tokyo is no longer a residence for the working class. It has mutated into a rare asset for the wealthy. Historically, when Tokyo prices went up, neighboring prefectures followed. That was the ripple effect. This chart shows that the ripple effect is broken. Look at the red line, that is the Tokyo 23 wards soaring on asset inflation. Now look at the gray lines, Saitama, Chiba, and Kanagawa. They are flatlining. We're seeing a decoupling. The asset logic of the center has cut ties with the wage-based reality of the suburbs. Developers tried to fight high prices by building smaller homes, under 100 square meters. But this strategy has collapsed. The average price for even a small-scale home in the 23 wards has hit a record high of 86.72 million yen. The land value is simply too powerful. Shrinking the footprint no longer ensures affordability. The theory that if you live small, you can live central is dead. This creates a massive divergence. In the suburbs on the right, small home prices have dropped below 50 million yen to match buyers' budgets. But in Tokyo on the left, prices ignore those budget constraints. To buy in the 23 wards now, you need extremely high credit, regardless of the square footage. So, where do the buyers go? They rush to the secondary market. Demand that spilled over from the new market is causing an abnormal surge in used homes. Look at the graph. The Tokyo 23 wards saw a massive 28.2% month-on-month surge in used home prices. This is structural substitution demand. But be careful how you read that data. It's not that old houses are suddenly expensive. The market is shifting toward young used or shallow-age properties. Buyers are desperate for homes that are close to new. We are seeing the Westernization of the market. High-quality used properties are trading at prices near new construction, leaving older, depreciating properties behind. Now, let's look outside of Tokyo for a warning signal. In Nagoya City, new home prices dropped 9.6% in a single month.
Why?
Because regional cities are driven by real demand. Actual residents with local salaries, not investors. When prices exceeded local income levels, the market hit a ceiling and corrected. Nagoya is likely a leading indicator for what will happen to the Tokyo suburbs soon. To understand this, we must realize there are two different engines running this market. Engine 1 is asset logic. This runs Tokyo 23 wards and prime Kansai areas. It is fueled by investment money and moves independently of supply and demand. Engine 2 is real demand logic. This runs the suburbs and regions. It is fueled by local income and is highly sensitive to interest rates and inflation. This brings us to the new market hierarchy for 2026. It is a pyramid. Tier 1, the winners. Central asset areas. High prices maintained by financial logic. Tier 2, the alternative. Young used homes and strategic small homes. Active demand, but severe selection is required. Tier 3, the adjustment area. Suburbs and regional cities, facing the limits of affordability and price decline. Our verdict is simple: the end of the high tide. The era where the whole market rises uniformly is over. We have entered a phase where the true power of each individual location is severely reflected in the price. A mistake in selecting the area now leads to significant asset damage. The market has become unforgiving. To summarize our findings, the wall, 100 million Japanese yen, is the new normal in Tokyo. The decoupling, central inflation has detached from suburban wages. The mutation, the used market is surging as buyers seek high-quality alternatives. The warning, Nagoya's drop signals the ceiling for real demand markets. Thank you for reading our report. We will continue to track these macroeconomic shifts in the Japanese real estate sector. If you found this data analysis helpful for your market perspective, please like and subscribe to receive our future briefings. Thank you.